Welcome to this special webinar titled Future Financial Outlook, Taxes, Retirement, Wills, Plan Giving, and Bequests. Our moderator today will be Ruth Igo, Director of Major Gifts at North Park University. Today's presenters are two North Park alumni and financial specialists, Peggy Bley and Jonathan Heintzelman. Peggy is a CPA who operates her own tax practice in San Francisco, California. She has served on the North Park Board of Trustees since 2015 and that has included service on the Finance, Audit, and Advancement Committees. Jon is a Senior Advancement Advisor and Consultant to the President at North Park University. He has over 40 years of experience in advancement and plan giving, including leadership positions at Northwestern University, Loyola University, and consulting firm Termolin, Watkins, and Brandt. This webinar was pre-recorded to ensure that we covered all of the topics and submitted questions. Now I will gladly introduce Ruth to get our program underway.
Thank you so much, Kristen. Before we delve into financial, retirement, and estate planning, we would like to ask North Park trustee and accountant Peggy Bley to help us lay the groundwork for this discussion. Peggy, could you begin by going through some income tax fundamentals for all of us?
Thank you, Ruth. I would be glad to do that. So we're going to start with the marginal tax rates. So marginal tax rates go from 10% all the way up to 37% of taxable income. Anyone can look up the tables for marginal tax rates by searching for marginal tax rates on their web browser or going to the Internal Revenue Service website, irs.gov, for details. The marginal tax rates go up in an uneven incremental rate. So, for example, if you were married filing jointly, your first $19,750 of taxable income is taxed at 10%. And then taxable income from $19,750 to $80,250 is taxed at 12%. And then it jumps up to 22%, 24%, 32%, 35%, and 37%. Each having a different range of taxable income associated with the percentage of tax. In planning for retirement, how much your top tax bracket is currently versus where your top tax bracket will be during your retirement can help you make tax advantageous decisions for your future. Long-term capital gains, that's assets held for more than a year before selling and sold for a gain, and qualified dividends are taxed at a more favorable rate. The tax rates are 0%, 15%, and 20% based on taxable income. There is an involved worksheet to determine what gets taxed at which rate. As you can see, it is not a flat tax for long-term capital gains and qualified dividends, although more favorable than the marginal tax rates for ordinary income. Something else is the additional tax of 3.8%, which is the net investment income surtax. For single taxpayers with an adjusted gross income of over $200,000 and married filing jointly payers with adjusted gross income of $250,000, interest, dividends, capital gains, that's long-term and short-term capital gains, have this additional tax to consider. In order to calculate your taxable income, a taxpayer needs to see if they are taking an allowable standard deduction or can itemize their deductions. The standard deduction for married filing jointly taxpayers for 2020 was $24,800, and it is going to go up for 2021 to $25,100. For a single taxpayer, the standard deduction for 2020 is $12,400, and it will go up to $12,550 for 2021. The standard deduction is indexed for inflation, so it is anticipated to continue going up over time. There is an additional add-on for taxpayers who are 65 or older or who are blind. So there is actually an additional amount for that. So, for instance, in the case of somebody who is 65 or older, you have that extra $1,300, and so it can get harder and harder and harder to itemize deductions. Taxpayers can calculate whether or not it's more advantageous to use the standard deduction or to itemize their deductions. So itemized deductions include medical deductions that exceed 7.5% of adjusted gross income, state and local taxes, which is the lesser of whatever you have expended during the year, or $10,000. So it's limited to $10,000 if you have expended more than that, which is easy to do for certain states. And interest, which is limited to a mortgage interest of $750,000 if you have a mortgage that began after December 15th of 2019. However, there's a grandfather of a mortgage interest of $1 million if you had your mortgage before December 15th of 2019. But it is limited to the interest on $1 million or the interest on $750,000. So, and it is loan originated when you have purchased your personal residence. It's based on that loan amount. It is not based on refis unless the refi is equal to or lesser than what your loan balance was when you refied. So in other words, you can't have a $1 million loan, original loan, have paid it down to $800,000, and then turn around and do a refi for $1 million. Then $200,000 of that will not be deductible. $200,000 of the interest on that will not be deductible. So just keep that in mind. Also, the equity loan, it has gone away. So the interest on an equity loan is no more. So there's no deductibility for that. However, you can, if you have a second home, the limitations are the same for a second home. So you can have that cabin in the woods or whatever, and you can deduct interest on that also. But remember, not those great amounts of, past $1 million, or in this case, $750,000. And then, of course, included in itemized deductions is charitable deductions, of which Jon is going to talk about.
Thank you so much, Peggy. Given these tax fundamentals, Jon, as someone who has worked with many donors and scenarios through the years, what are some of the ways in which people can realize tax benefits through charitable giving?
Thanks, Ruth. Charitable contributions from alumni and friends of North Park have played a critical role in the ongoing support and success of the university throughout the years. Support for not-for-profit organizations such as North Park has long been established and encouraged, actually, by the tax policies of our government in the form of providing tax incentives to give through the income tax charitable deduction. The recent Tax Act of several years ago altered this landscape a bit by increasing the standard deduction, which Peggy referred to, and also placing a limit on the deduction for state and local taxes. The net result of these actions caused the number of those itemizing these deductions, including the charitable deduction, to reduce by almost 50%. Despite this, here at North Park, we have continued to experience tremendous support from our loyal constituents. One area of potential growth for charitable contributions, both now and into the future, for all not-for-profits, is the ability of individuals to contribute appreciated property instead of cash. With the expansion of the stock market in recent years, many own stocks that have noticeably appreciated over time. Although gifts of cash are always welcome, gifts of appreciated property have potential tax advantages for the individual over gifts of cash. This is because the tax laws allow one to deduct the fair market value of appreciated property held for at least a year at the time of the gift rather than the cost basis or the amount that was originally paid for the stock at the time of purchase. If the same stock were sold and the net realized contributed, one would possibly owe capital gains tax on the sale, and the net gift would potentially be lower. Another option for those considering a gift is what we call generally life income plans. North Park offers several types of such plans that allow one to make a donation and receive income back in return for a period of time or for the life of the donor and another. These types of gifts are called irrevocable gifts since they are irrevocable once established. Income paid out can be of a variable or a fixed nature depending on the particular plan and the particular needs of the donor. Since these plans are irrevocable, the donor is entitled to an income tax charitable deduction at the time the gift is set up. The amount of the deduction is a calculated amount. It is a portion of the total value of the gift. Also, these life income plans can be another great way to save on capital gains taxes, as gifts of appreciated property held for at least a year are not taxed on the transfer to establish such a gift. If you would like to explore how one or more of these life income plans at North Park might be of interest and benefit to you, the advancement office at the university would be pleased to work with you on this. Additionally, we also enjoy a partnership with Covenant Trust Company, which helps us in the investment and management of these life income plans. I'd like to touch on a couple other related options for charitable giving that one might consider. One of these is called donor advised funds. These vehicles are a rather recent innovation to charitable giving in the last couple of decades, but have proved to be very popular with individuals. A donor advised fund allows one to establish such a fund with a gift of cash or other assets to an institution that offers management of such funds, usually significant financial institutions, but there are quite a few. The donor of the fund realizes a current charitable income tax deduction in the year of the gift, but is not required to designate any charitable recipient of the gift at that time. At a later date then, or dates, the donor can then advise the fund manager the charities that he or she would like monies from the fund to support. The fund would then disperse the gifts to the particular charities at that time. However, since the donor took his or her charitable deduction at the time of the original transfer to the fund, there is no subsequent charitable deduction when funds are later dispersed to charities. That would be double counting of the deduction. One other charitable vehicle or strategy I would like to mention is the Qualified Charitable Distribution, or IRA charitable rollover. This vehicle was made permanent in the tax law as recently as 2015, yet has become a very popular means of giving for those individuals who are old enough to be subject to the required minimum distribution rules for holders of IRAs. The required minimum distribution or RMD rules require that IRA holders must withdraw each year a computed minimum amount from their various IRAs. Failure to do this possibly invokes a 50% penalty tax on the difference. So it's not something you really want to play around with. These withdrawals are then included in the individual's taxable income for the year as ordinary income. The IRA charitable rollover allows one to make a direct contribution from the IRA to a charity such as North Park without recognizing the amount of the gift as income for the year of the gift. There is no income tax charitable deduction for this gift, but there's also no inclusion of the gift in one's reportable ordinary income for the year, thus reducing the income tax obligation for the year. These rollover gifts have become increasingly popular as a way to make a gift and save on income tax at the same time, even if one no longer itemizes deductions under the increased standard deduction. One item to note, the required minimum distribution was put on hold in 2020 due to the pandemic, but is back in force as a requirement for 2021. Now I'm going to turn this back to our moderator, Ruth.
This is such great information, John, especially about RMDs coming back in 2021, and it's so good to consider. So Peggy, many of us are looking at Social Security as a way to help guarantee a solid financial future in retirement. Can you walk us through some of the fundamentals of Social Security, how it works, and how it can work for us?
First of all, let me encourage everyone to go onto the Social Security website, which is ssa.gov. It is an amazing and wonderful website that can answer a plethora of questions that you might have regarding your retirement. So it answers things that are in a number of different situations. It really does answer a lot of questions. Also, it is very easy to use, and I actually highly recommend it. But for those who want just some fundamentals, there are 3 choices that you can have regarding your Social Security. You can take your Social Security early, and that is at 62. So that is not at full retirement age. And at 62, you can expect to have a discounted amount of your Social Security benefits for the rest of your life. And the interesting part, I looked it up, and actually it is quite telling that for people who whose a birth date landed on 1937 or earlier, the reduction was 20%. But guess what's going to happen? It's incrementally going to go up. The reduction will incrementally go up. And people who were born in 1960 or later are going to experience a 30% reduction in what their normal retirement would be under Social Security. So it is important to recognize that before you make a decision like I'm retiring at 62. Also, another thing about retiring at 62 is that if you plan to actually do some work, so some reduced work, like maybe you go and you pick up an odd job just to kind of supplement a little bit. Just remember that for 2021, your limit for earning is $18,960. So past that, for every $2 that you earn past that, $1 is deducted from your Social Security. Yes, so you have to keep in mind that if you are continuing to work, 62 is probably not the option for you as far as that goes. Now, full retirement age. Well, that is going up and up and up also. And what I mean by full retirement age going up is that it is taking that much longer to be at full retirement age. So, for instance, if you were born in 1957, which means that you're turning 65 next year, you actually, full retirement age is 66 and 6 months. That's your full retirement age, not at 65, 66 and 6 months. And that is going to, and it goes up every year, it goes up by 2 months until you were born 1960. And at 1960, it's at 67 years of age. And it doesn't look like they're going to continue with bumping that up, but who knows? But what they wanted to do is they wanted to make the change from 65 to 67, and they did it by just bumping by 2 months incrementally every year from the time that you were allowed 65 to 67. So 1960 and later, it will be 67 years of age, will be your full retirement. Now you can wait. You can wait until 70, the age of 70. And at the age of 70, not only do you can still continue to work if you really so desire, and at your full retirement age, you can continue to work as you so desire, except for that first year that you get Social Security. And for some reason, that first year, if you earn more than $50,520 before retirement, before you reach full retirement, it's for every $3 that you earn, they're going to take away $1 of Social Security. But that's only for the first year. And then after that, you can earn any amount of money that you want after full retirement. And as I said, then you could also take extended at 70 years of age. And at 70, you actually get a bump up in your Social Security. So if you can wait until 70, you can have a bump up of as much as 8% of your Social Security benefit. So for some people, especially if you think you're going to be living a long time, that is, or that you're going to be working for a lot longer, that is definitely an option for you regarding Social Security.
That's really interesting, and the benefits we see delaying our retirement in that way. So while Social Security is often considered a supplement to our retirement portfolios, the keystone is hopefully going to be our retirement plans. As you might imagine, Peggy, our audience submitted numerous questions on this topic. And I should note that while for our purposes you can give general advice, you can't speak to the specifics of any individual's situation as you're not their accountant and don't know their full personal financial picture. That said, can you start to walk us through some of the ways in which retirement plans work and function in retirement? Jon touched on this a little bit, but can you tell us when withdrawals begin and the personal financial impact of required minimum distributions, or RMDs?
So a regular IRA, there's a required minimum distribution now as of the age of 72 and up. So before it was 70 and a half. And so if before the end of 2020, if you were 70 and a half or more, you had to take your required minimum distribution, which means no matter whether you needed it or not, you take a distribution which is based on an actuarial table based on the market rate at the end of the previous year, and that is your required minimum distribution, and it is ordinary income. There is no tax advantage. There's no capital gain rate. There is no qualified dividend rate. It is all ordinary income. So that's where that marginal tax rate kind of comes in, and those tax rates come in. And this is for IRAs only. But a Roth IRA, on the other hand, does not have a required minimum distribution. So if you are concerned about whether to have a Roth or not have a Roth, that is possibly a consideration for you, because you will not be forced to take something that you don't need if you don't need it.
That's interesting. So Peggy, one question we received was, is it now required that you take your RMD from a regular IRA before you do a Roth conversion? And secondly, can you do a Roth conversion more than one time in a calendar year?
So it's yes to both. So if you were to do a Roth conversion, you have to, and you are 72 and older, and so you are already in that required minimum distribution, yes, you have to take your required minimum distribution before you can do any sort of conversion. But remember, you can convert before 72. There is no required minimum distribution. So keep that in mind. You might want to do all these things before you reach 72. Also, you can do a conversion as many times as you want. There's no limit to that. There is a limit if you want to roll over your IRA. That's a different kind of limitation, and that's only once a year. And I think that's probably what this person was really thinking. But conversion-wise, you can convert more than once a year if you have that much to convert. Okay.
Interesting. Another question we received from an attendee was, because of various financial ups and downs, my current retirement assets, my 401k and my Roth, are not where they should be at this stage of life, age 50. Should I move from a moderate to moderate aggressive investment strategy?
Well, a moderate to moderate aggressive requires that you have a toleration for more risk to your portfolio. So the highs are higher, the lows are lower. That's actually traditionally what I have observed, and I think what a lot of financial planners have observed. Just remember, I am a CPA, not a certified financial planner. If you really want to have a good discussion of that, I think a certified financial planner is the way to go. And you can find those in the Yellow Pages, but you can also get good advice from brokerages if you have a good relationship with a brokerage. And if you, for instance, Schwab Preferred Client or Fidelity or Vanguard or any one of a number of high quality financial brokerages will have people that can talk you through what the implications are of doing that kind of thing for beefing up your retirement.
That's great advice to get a certified financial planner involved. Another question and comment we received from the audience was, is there a way to ramp up retirement savings? We have missed approximately 7 years of saving or contributing in any way and are trying to strategize how to put that back. Peggy, how would you advise someone in this situation?
Well, first of all, you can't put it back. You can't go backward. So they're very clear on that. However, there are some things you can do. You can maximize your 401k contributions. So every year, maximize, and take as much as you possibly can. You can also, if you have a pension plan, 401k, and you do not have a deductible IRA, you can also have a non-deductible IRA. So that's a possibility. Also, if you qualify in that adjusted gross income limitation, contributing to a Roth is a great idea for kind of beefing up those retirements. But here's another thing. Why not create a portfolio, a regular portfolio? Remember now, I talked about qualified dividends and capital gains. They still have a better rate than ordinary income. So yes, you have to pay the piper when the piper's due. So in other words, if you get a dividend, you have to pay the tax on that dividend. And in a retirement portfolio, you don't have to pay anything until you're ready to take it out, but you're taking it out at ordinary income rates. So why not create a portfolio? Why not give yourself more than just your portfolio in your retirement account? I was thinking about this, and my husband and I have both. And so, you can kind of play with the numbers a little bit, and until you have required minimum distributions, you might want to go one way or another, depending on your tax situation.
That's good to know. We can't put it back, but we have a lot of options available to us, including our own portfolio. So our final audience question was, what is the best strategy to protect a 401k from climbing taxes if I'm about to retire in 20 years? Okay,
well, first, you can see if your employer has a 401k Roth. There is no taxable income or adjusted gross income limitation if you're taking a 401k Roth from your employer, as opposed to that. So you can make your payments from now on for the next 15, 20 years, depending on how long you're working. a Roth 401k works very well in that situation. You can also go and look at, there are on the web Roth conversion, or I should say IRA to Roth conversion tables that can tell you when you can convert from one to the other, where it would be tax advantageous. In other words, in a low tax year, that might be one of the ways you would want to do a conversion of some amount, so that you can kind of play with the marginal tax rate and not exceed your normal marginal tax rate. So there are some possibilities for actually also converting, and you don't have to convert 100%. You can just convert $20,000 a year, taking that into income, but then knowing that whatever the increases are through retirement, one, you don't have to take a required minimum distribution when you retire, and so it's protected that way. And two, it's protected because any increases in your portfolio of your Roth portfolio will end up being tax deferred. Or tax exempt. So so those are some things to think about.
That's great. Great strategies, Peggy. Thank you so much. So as an extension of financial and retirement planning, so many people want to leave a legacy, both to support their families in the future, as well as causes and institutions that have made a meaningful impact on them or that they care about deeply. Jon, what are some ways in which we can talk about the fundamentals of estate planning and how people can care for both their families and charities or causes in the future?
Thanks, Ruth. So first, I'd like to harken back to what Peggy just mentioned about investments for the long term outside of your retirement plan. I think it makes sense if you can afford it to do something like that, because those are not subject to the RMD rules of the IRAs that you get involved with later on in life. So it makes a whole lot of sense if you can afford to do that, to do it before you get to the retirement age requirements. I'm going to touch briefly on a few basic concepts and instruments in the area of estate planning. The first involves the creation of one's last wishes for distribution of assets, as well as other last wishes to be honored. The basic document for effectuating such wishes is a last will and testament. Although many view doing a will as something to be put off into the future, we all know that we cannot predict the future. And having a will or comparable document can not only put your mind at ease, but also head off issues and problems that can arise if one dies without a will. First, I want to address the issue of joint tenancy. For couples, it is normal for all the assets, including the residence, to be held in joint tenancy, which from a legal perspective means that if one joint tenant dies, the surviving joint tenant automatically owns the joint assets 100%. There is no legal proceeding for transferring the property, and a will does not apply. The survivor's ownership happens by operation of law, automatically. But if the joint tenants did not have a will, what would happen if both died together? Or if the surviving joint tenant subsequently died without executing his or her own will? In such case, we would have a situation called intestacy. And upon intestacy, state law comes into play and dictates how the deceased estate will be distributed. Generally to heirs under state law, leaving no option for possible distribution to non-heirs or charities, or in many cases, distribution to heirs, which would not be the heirs that they would want to have their assets distributed to. Also, for couples with minor children, a will can control who would serve as guardian of the children in the event of the couple's deceasing. If no one is specified, it will be left up to the courts to choose a guardian. Often, this is an area of dispute among relatives and friends of the couple. A simple will can prevent all this. With minor children, it is also important for the will to specify a trustee or person who would be responsible for managing the couple's surviving assets for the benefit of the children. Ideally, this could be the same person who serves as guardian, but often the skill sets to be the guardian of the child or children and the skill sets for a trustee are not embodied in the same person. In other words, the person who's best able to take care for the children may not be the best financial manager of the trust assets. Finally, in the event of more than one minor child, it is important to specify when the trust will eventually be distributed to the children. For example, usually when the oldest reaches a certain age, or when the youngest reaches a certain age, and that age is specified by the people executing the will. 21 is usually a minimum. It can be upwards of 30 or even 35. In most cases, when one dies with a last will and testament, the disposition of the estate will be governed by a process called probate. Probate is a judicial process to oversee and ensure the proper handling of the affairs of the deceased and to make sure that all claims against the estate and expenses have been paid. Once the court is satisfied that everything is in order, it authorizes the distribution of the assets according to the provisions of the will. Ordinarily, the probate process can take 9 months to a year from beginning to end, and depending on jurisdictions. The will also have specified a person to serve as executor to take care of the administration of the estate. An alternative instrument to the will is called a living trust, a revocable trust. The living trust contains the same dispositive provisions of the will with respect to distribution of the estate, but has several potential advantages not identical to the will. One of these is that a living trust, if properly executed and established, can avoid probate of the estate. It is a common notion that if one does a will, one avoids probate. This is not true. Just having a will does not avoid probate of the estate in and of itself. A properly set up living trust can accomplish this. Because a living trust can avoid probate, the estate theoretically can be distributed potentially much quicker to the beneficiaries, since there is no need to wait for the probate process to be completed. Finally, in most jurisdictions, a will must be filed with the county clerk, and hence becomes a discoverable public document. The living trust remains private, not subject to discovery by the public. For a living trust to work properly, once the trust document is signed, the assets owned by the creator of the trust need to be retitled in the name of the trustee, usually the person creating the trust. Also, having a living trust does not require the filing of a separate tax return. The normal 1040 is sufficient. There are several other estate planning documents that are an important part and can be an important part of any plan. Along with a will, it is recommended that one execute a durable power of attorney, which will allow designated individual or individuals to make financial decisions on behalf of the signer in the event of the incapacity of the signer of the power. It is called a durable power because it survives beyond capacity to grant the power. A normal power of attorney would not survive. Another important planning document is a healthcare power of attorney, which designates an individual or individuals to make decisions with regard to health and medical treatment in the event that the creator is for some reason not capable of making his or her own decisions. This is generally, but not always, a close family member. Finally, a document called a living will deals with the wishes of the signer with regard to life-prolonging treatment in the event of a terminal illness. Since laws affecting estate planning can vary from state to state, it's always a good idea, and we recommend that one work with a legal representative familiar with local laws in his or her area. For example, many states differ in what is required to properly execute legal documents, such as a will or living trust. So it is always good to check with a professional who is familiar with local law and can provide proper and accurate advice. From early days up to the present, gifts from estates of alumni and friends of North Park have provided significant and sustaining sources of support for the university. We continue to rely on such gifts and be most grateful. I will mention briefly several examples of how estate gifts can be crafted to support North Park. One of these is a specific gift of cash or property, such as appreciated stock. As noted, such gifts must occur either in a will or living trust. The donor would then specify the amount of the gift or the specific asset that he or she wishes to donate to the university. Such gifts would then be distributed to North Park upon the death of the donor and would take effect before any distribution of what is called the residue of the estate, which is what is left after all the specific gifts have been distributed. It is also possible to designate North Park to receive a percentage of the residue of the estate. Unlike the specific gift, the amount of a gift from a residue would fluctuate over time as the amount of one's estate fluctuated. If you might be thinking of including North Park in your own estate plan, and we hope you are, it's always a good idea to check with the advancement office to make sure that whatever purpose you might have in mind for your gift is possible of being fulfilled. Unrestricted gifts, of course, are always most welcome, but we realize often donors have a specific purpose in mind for their own gift, and we want to be certain that the university can satisfy such a purpose. Also, gifts of endowment are most welcome, as these types of gifts survive in perpetuity and provide ongoing financial support for the future of the university. For example, an endowed scholarship fund can be established for $25,000 minimum. Finally, I'd like to mention once more the university's partnership with Covenant Trust Company. If you are considering setting up an estate plan, I am sure that representatives of CTC would be most willing to work with you on the details of your plan. They also assist the university with the management of our charitable life income plans that I mentioned earlier. Thanks again for tuning into this webinar, and now I will turn it back to Kristen for a wrap-up.
Thank you, John. And thank you, everybody, for joining us and for submitting questions to help guide our conversation. I want to give a very special thank you to our moderator, Ruth Igo, and to our wonderful alumni and guests, presenters, Peggy Bley and Jon Heintzelman. Thank you so much for this rich conversation. For all of you who have tuned in, a follow-up email with a brief survey will be sent to you, and the recording will be available if you want to rewatch it or if you know of anybody else who may want to view it at a later time. If you have any follow-up questions, please direct them to alumni@northpark.edu. Thanks again for joining us, and have a wonderful day.